So, hey, Travis, thanks for joining me today on my show. This is Real Estate with Caroline, and I really appreciate you taking the time to come on and discuss some of the challenges I'm facing with financing issues here in Florida. So, you're
Awesome.
a lender, just to give everyone, you're a lender with Supreme Lending, Travis
Yep.
Kimball. I'll put your contact information below. But why don't you introduce yourself and just tell people where you're from, what you do?
Sure. Yeah, my name's Travis Kimball with Supreme Lending. I've been in the business probably over 15 years. Been with Supreme about 2 years now. Own my own mortgage company. Originally from Maine. Been down in Florida for about 25 years. So I've kind of seen the whole real estate market from the good days, the bad days, gone through the goods and bad. So but really know the market really well. There's been a lot of struggles out there. You kind of hit on the condo market a little bit. So I'm here to help and answer any questions you have, and maybe we can help you know people out there that have certain questions. Maybe we could get them the answers that they're looking for.
Okay, and your contact information is in the comments below, just in case anybody wants it. Travis Kimball, Supreme Lending. And I'm Caroline Sesi, I'm over here, Real Estate with Caroline. Same thing, been a real estate agent for a while. And I am seeing challenges that I haven't seen in a while, like this insurance issue.
Right.
So from my end as a real estate agent, I'll get people who will come in and say, I'm a first time buyer. I can put 3% down or 5% down. And their price point doesn't necessarily allow for a single family home, in my area, our area, Palm Beach, Broward counties. They're getting, stuck into condos. And not that a condo's bad, but just because a lender says, especially ones that are out of state or don't know our area, you can put 3% down, the building also has to qualify. So can you explain a little bit about that? Because people think it's just me, and I'm like, no.
Yeah, sure. Yeah, so condos is a whole animal itself, and it's really getting more difficult. And as far as condos, just like the borrower, you have to get qualified with income and assets as a borrower. A condo has to basically go through the same process, especially for FHA and Fannie Mae and Freddie Mac. Basically, there's qualifications that the condo has to have certain budget and reserves to qualify. And then the other big thing that we're running into right now, and you hit on a little bit, was for the insurance. A lot of the massive condo policies that cover condos now, they have a 5% hurricane wind deductible. But in order to because of the premiums going so high, now they're changing those deductibles from 5% to 10%, so they don't have to assess the people that live there. And that's an automatic denial for Fannie Mae once you go over the 5%. So the only other option is we at Supreme Lending, I do a ton of condos, a lot of fallout from Fannie Mae because we do have a portfolio loan that, couple things, we don't require any condo questionnaire. So any condo that has budget reserve issues, there is no condo questionnaire needed. We kind of take out the stress of, oh God, is this condo approved or not? So we take that guesswork out. And then also the big thing on the insurance, we do still lend on condos that have the 10% hurricane deductible. But anyone is looking for a condo, those are the first questions when you start looking for a condo. And that's my questions when I speak with a realtor would be two things. Do they have budget and reserves? And I need a copy of the master condo policy, because that right there is going to tell us if it's going to be a Fannie Mae project that we can get approved, or if not, we're going to just do our portfolio loan.
Right. So for me, a couple of things that people will ask me, so I'm going to ask you to go a little further into this, and not so everyone becomes, an expert on the that's what you're qualifying them and all that. But what that means is, so say there's $1 million damage on a hurricane. We used to have 5% of that, meaning 5%. The condo people, the homeowners have to cover, and Now they're increasing it to 10% so the deductible doesn't go higher and the association dues or assessments don't go higher. So now instead of 50,000, it's 100,000. So you're paying that first 50 instead of 50, now 100 or whatever 10% is.
Right.
For
Right.
5%. And that's what that Fannie Mae is saying, okay, we're not going to do that then. We're not going to lend on this. So yes, you're qualified for 3% down, you as a person, but the property is not.
Right.
And
right.
for example, percentage wise, because I don't want to say it, I'll ask you percentage wise. I have a number in my head. How many buildings in South Florida would actually qualify for a Fannie Mae or FHA loan? Like 10%, 5%?
Well, here's the thing on FHA. I know FHA, and you could pull by county. There's probably about a handful of FHA condos in Broward County, and there's probably, and I'm talking, 12 to 14 maybe, and same thing in Palm Beach County, probably 9 to 10. And most of those condos that are FHA approved, those are in the higher value wise, and that's why they're probably approved. Fannie Mae, there's probably going to be more 30, 40, 50%. I don't know the exact numbers on that, but more are coming not approved because of the condo issue. Like I had talked to one HOA where their insurance premiums were like 200,000. Well, their insurance premium was going to go up to like 600,000 if they kept it at 5%. Well, that's you're talking a lot of money that they would have to assess their homeowners. So the only option they had was to increase their deductible to 10%. And then maybe it was only $1,000 increase that they had to assess all their homeowners. So we're seeing it more and more. I've been kind of labeled the condo specialist just because we do a lot of the niche condos that Fannie Mae. I get calls, daily that people are supposed to close, and at the end of the line, they're finding out that the building can't get approved. And it is a process, no one, unless they're listed on the Fannie Mae approved list, there's no way to know exactly if a condo is going to get approved. It's a process, typically takes a week or 2 weeks to get something approved. So the benefit with us would be if we did try to get it approved, we still have a fallback option to fall back on the portfolio loan. But educating the borrower, the process, I guess, and, letting them know the expectations that not only you have to get qualified, the condo actually has to go through their own qualifications.
Exactly. And that's where I'll clarify a little bit, just so I make sure we're all on the same page. You were saying there's probably 12 to 14 buildings in the whole county that would be FHA approved, right? Out of all the buildings, there's not many, and they're usually higher end. And then the issue becomes, which is another thing, because if you need a lower down payment and okay, we get you in, then don't forget, there's assessments, like you said. So they're assessing, they're saying, okay, we'll increase the amount. So if something were to happen, now you're going to have to pay more than you did to fix the damage. And in addition to that, you're going to have an assessment because the policy is still higher than it was. And then you have, so that's one issue, the insurability, right? Yes. And then that takes us to budget and reserves, which is, so I'll say it from my end and then you can say, so DeSantis, enacted a law where everybody has to have 100% reserves for certain items, not everything, by the end of December 31st, 2024. He did that when the Surfside building collapsed. My opinion, the building collapsed. What happens here is we have a lot of people on fixed income or it's their second home. And when they go to vote to do repairs, they were deferring maintenance. So people will say, oh, I like this condo building because the association dues are low. And yes, you can get into some buildings are poorly managed and maybe they're spending their money crazily, but really what it usually is they're just not doing the maintenance. And that's why the dues are lower than the building down the street. It's not because the other one's so much higher, it's because they're doing the work. Well, DeSantis said, you don't get that option. We can't have buildings just collapsing. You have to have reserves for this stuff. So not only do people defer the maintenance and they have to do the work, now they have to have a budget for doing the work moving forward. So these issues don't happen. And that's what you're talking about with the budget and reserves, which is another issue with condos, correct?
Right.
And
Yes, and all the condos are going through their 40-year certification now. So in order to get them up to code, basically, most of the condos are using their reserve money that they've set aside. But again, as you know, most of these buildings didn't have a ton of reserves, so that's why people are getting assessed to cover for the difference.
Right. So in addition to the association dues going up, they're also getting assessments. But you can still approve people in these situations. It's just coming to you first and looking at the whole picture. Because a lot of people will go, well, forget it. I can't buy anything. And it's like, that's not necessarily true.
Right.
But you need to deal with somebody who's local, in my opinion, local to South Florida, because we just know the market, what's going on, what's happening. And then you can say, well, here's what I can do for you. And if you're not approved for anything, these are the things you need to do to get approved.
Yeah, I always tell
people, right?
Yeah, I always tell people to call in, let's fill out an application, let's, connect you with a realtor that knows the area, and let's see what you're approved for, because there is a lot of, I see condos all the time that say cash only because they were told it's not Fannie Mae, but they don't know there's other products out there like we can do, or, where we don't require any condo questionnaire. So the best advice I have for anybody is, apply. There's no fees up front. You make an application, then you know exactly what you can afford, what's going to work, and what's the best option for you. And if you can't qualify now, at least we put you in a position to do something, what you need to do to get to purchase a new home.
Exactly. And just so, because I don't want to get into the weeds with it, but people will say, well, what's a condo questionnaire? That's something that the banks require. So there's like what I say, you probably say it better than me, but there's like a short form, which is a limited questionnaire, and then a full one, which is like 4 pages. They're asking how many renters are in there, how much of this. They're asking so many questions that sometimes they'll say, well, we don't finance if there's more than 25% renters. Right. So there's all these things, and that's where you wouldn't know unless you're local to the area and you're constantly doing this, right?
That's correct. Yeah, besides the budget, they need 10% reserves. I mean, there's all other stipulations where like someone can't own more than a certain percent in a unit to be Fannie Mae qualified. There's certain delinquent ratios on like FHA and stuff. So there's a lot more than just your basic qualifications. And a lot of ththese HOAs, it's not the easiest to get the questionnaire. So it's, sometimes it's challenging just to get the HOA to fill out a questionnaire. But yeah, there's, a lot of people think there's a couple questions and that's it. But it is a pretty lengthy process to get something approved through Fannie Mae if they're not already been approved. And we've had places that have been approved, and then they changed the insurance literally within the last 30 days, and that automatically kicks them downgraded out of Fannie Mae. So you just, like I said, for any condo, you just want to make sure you're dealing with someone that knows the market, knows the condo business, and knows what it's going to take and what type of loan that you're going to need for that building.
Exactly. So all those questions, it's like I always get people, they're like, oh, my lender wants so much information from me, and then I give it to him, and then he wants my bank statements again. I'm like, well, it was 30 days ago. They need the updated statements. It's the same thing with the building you're buying.
Absolutely.
And
Absolutely.
People have to, so that's where true professionals come in. And that's why I appreciate you taking the time to explain this. That way people can really get a clear picture of what's going on. One, when you're trying to buy with a lower down payment, but then I have another issue is, so I have people, maybe they're on fixed income, maybe they're 55 and older, and now they live in the building. Some of them didn't even have a mortgage, or maybe they have the 3% mortgage, and now they're getting hit with assessments, money they don't have, or they're getting hit with higher dues, which it was not fitting into their budget. And they're like calling me, and it's sad because, either A, they're going to be forced to sell, or B, I send them to you. And the reason I send them to you is, and this is, can you explain more like, second mortgages, reverse mortgages, all that fun stuff. when we get
Yeah,
into
so obviously reverse mortgages for a certain type of clientele, basically. There's a lot of seniors that are in a home now. They don't want to leave, right? They're on a fixed income, so they can't really qualify for income. That's when a reverse mortgage would be best for those people. Or they don't have the extra money for the assessments, but they want to stay in the community. They want to live the same lifestyle. That's the biggest thing that I see with reverse mortgages, because people always say, oh, reverse mortgages, there's a high cost, and why don't they just sell and move somewhere else? But you got to remember, a lot of seniors, they've been in their home 30, 40 years. They don't want to leave, right? And if they're sitting on a free and clear property and they can access that money to allow them to continue to enjoying their lifestyle, then that's where, that's the best option for them, right? Where they could, if they own a home for say 400,000 free and clear, where they could maybe take out 200,000, and that would be money that they'd be able to live on or pay the assessments. So that's the biggest thing on the reverse mortgages. It's basically it's got to fit the right person, where if they're struggling to make the bills, they want to stay in the same community, it is definitely an option for them out there.
So a couple things, and as a realtor, of course I want to, oh yeah, I want to sell your house. No, I don't always want to sell your house, because I know that you're being forced to. So if I can offer other alternatives,
Right.
that's what I believe. I'm here to help my community. And obviously when somebody's ready to buy or sell, help them do that. But that doesn't mean just anyone say, yeah, great, let's sell. So like,
Right.
I was always hesitant because, I've been in the business for a while, and back in the day when they were doing reverse mortgages, people got kicked out of their homes. So can you
Right.
explain the difference? Like, what's the difference with these reverse
Yeah,
mortgages?
so they've, since then that, obviously they've stepped in and made a lot of security features to, this courses now they got to take. And, there's limits as far as like, say, back in the day, if, someone they could access $400,000, they would get all the whole $400,000 right up front. And you know what happens with that money, right? It disappears pretty quickly.
Going on vacation, I'm going on some
Right.
cruises.
So now, say if they're eligible to, maybe take 400,000, there's a certain amount that they can get in the lump sum the first year, and then they have to wait a year, and then after that they can access the money. It's almost like a line of credit. So there's a lot of things now where to make sure that people don't get in trouble. The other thing they put in place, like it's called the Lisa, where your taxes and insurance are built into the loan, right? So back in the day, they'd be given $400,000, but they'd still have to pay their taxes and insurance. Well, once that money's gone, they can't afford their taxes and insurance. Now with some of the reverse mortgages, without getting too far in the weeds, some reverse mortgages require the tax and insurance to be included in the loan, so that client is never where they're in a position where they don't have the money to cover that.
And a reverse mortgage, just so I understand, like, this is my explanation. So my simple explanation, obviously you go into detail with every individual person and their needs, but okay, you have a house that's worth 300,000. You don't
Right.
have a mortgage. You could get access to half of that 150. You're not going to get it all at once. You're going to get some
Right.
of it year one, some of it year two, if you want it, but you don't make payments on this.
Right. That's
You're
correct.
right? Yeah. Like, that's just money that you're getting, and you're not making payments. That's something your kids will have to deal with. You stay in the house.
Yeah. And
Until
a big
pass away or sell.
Right. A big myth on the reverse mortgage is basically you're giving your house to the bank, but that's not true at all. A reverse mortgage is just like a regular mortgage. If you went to do a refi and you took out 300,000, you could sell that house anytime. You can refinance out of reverse mortgage anytime. So the big myth, is, oh, I'm not doing a reverse and giving my house to the bank. That's not true. It's just like a regular mortgage. So if you get $300,000 of a loan, you could pay that off. You could refinance that. You could sell that house, and that's just a loan that would be due to be paid off. So there is some other examples where we have clients, like maybe they do have a low rate right now, like a 2-3% rate, and they only owe maybe 200,000, and they say, well, no, I don't want to, I don't want to get rid of my first mortgage. We still have, it's called a home safe second, where there's no payments on the second. So they would keep, and this is good for people that are either have, they're looking to access a small amount of cash, and they want to keep paying on their first because they want to keep paying the principal down. But they don't have the income to qualify for, say, like a home equity line of credit. We can do a home safe. It's almost like a reverse. And basically it is, where you just don't have any payments on that second mortgage, but you're able to get that cash to do whatever repairs. Like the big thing we talked about, insurance. Like, so if someone has a single family home right now, they're running into big issues where roofs need to be done, right? So, and then, for retirees, if they're on a fixed income, they don't qualify for a traditional refinance, right? So we can keep them in their regular mortgage at 2-3% that they have now, and just get them a second, where there's no payments, no income requirements, to get them the money to repair that roof. So there's a couple different options, and on that product, you only have to be 55.
And say I wanted to pay it off, I'm allowed to pay it off, right? Like, I don't have to move. I can just say, well, I don't have payments, but so for example, I have a client, yes, it's a detached condo community where they're responsible for their own roofs. So we have situations here where now insurance companies aren't only raising the rates, they're saying, yeah, we tripled your insurance rate, and by the way, you have to redo your roof.
Right.
Well, my roof is $23,000, and then my insurance went from $2,000 to $6,500. Like, I just don't have all of this. So they could, but they don't want to. They have that 2 or 3% first mortgage. They don't want to get rid of it, but they need a chunk of money. They might have like income from other assets, different things coming in besides Social Security, so they could pay it. And then that's when they come, I have to sell. And I'm like, yeah, of course, like I said, if that's the best option, but I look at everything. You might not have to sell, or that might not be what's best for you right now. Maybe what we need to do is get you the cash to do that roof, pay for the insurance, and then now you just make monthly payments and pay that off. Right? Like
that. So yeah, that would be a perfect option to do the home safe second, to get them the cash. They still keep their 2% rate. And it's the same thing. It's basically the same as a second or a home equity line of credit. If they owe 200 on their first, and we do a second for 100, down the road, if they owe 300, if they sell it, that's what their payoff is, the 300, right? So yeah, there's a lot of different options.
Sorry, the only difference I would add, and correct me if I'm wrong, is in this scenario, interest is accruing because they're not making payments on the balance.
Correct. Yeah.
So that's the only. What you would it's a downside if there are better options.
Right.
But
well, here's
a great option for a lot of people here. Like we have a lot of communities where this is actually a great option, right?
Yeah.
Sorry, Ed.
And that does come up where people, they don't want to do a full reverse mortgage because it does, the balance does continue to grow, and they want to leave their house to their kids or whoever. So that's why sometimes they want to keep their first. So they are paying their first down, even though that small second is increasing. So they're still not losing a lot of equity. So in their mind, they're still doing the right thing, because then they're still going to have equity to a home to give to their kids. So absolutely, that you hit it right on the head as far as, but that's where we do a lot of those, because people want to stay in that low rate, but they don't want all their equity to continue to decrease. So they'll do that second. But everyone's situation is different, so.
Yeah, I joke because I'm like, well, it depends. It's not only leaving it to your kids. I have a lot of people, their fear is, well, what if I live till I'm 150? It's a fear, like, well, what if, so that's why it's just good to talk to people, get those questions answered, and then make the best decision that's for you. Nobody's going to, that's just how it is. And Another thing that I have that I forgot to mention is, so like I'll get people that are here, okay, they want to move into a 55 and older community. Now, some of these communities say you have to make 55,000 a year. They have income requirements, again, because there's a maintenance component to living in these communities. They don't want people voting, I defer the maintenance or whatever it is. They want to make sure you can afford to pay to live there. That being said, there are some that don't, there's different things. So what happens when somebody has a lot of assets, they're not really showing any money? And does it have to be 55 and older? Like, can you explain that a little bit?
Yeah, so we run into this quite a bit, especially like retirees, where they may be on Social Security, but they got $500,000 or $600,000 in the bank. Well, they go to a traditional bank, they're making $2,000 for Social Security. They're not going to qualify for any loan directly through the bank, but they have 600,000. So we do have a couple loans out there. We do a no ratio loan that's asset based, and then like an asset amortization, where basically we're going to take the 600,000 and we're going to compute an income off that 600,000. So they'd have their Social Security, and plus it's almost like common sense underwriting, that we're going to determine that if someone has $600,000 in the bank and they can't pay their bills, what are they going to do? They're going to grab money from that. So there's a formula. So we do have a few programs for a lot of self-employed borrowers, right? We do a lot of bank statement programs. We do.
So this no income doesn't only have to be for 55 and older. It can be for anyone with a lot of assets.
For anybody. It's a no ratio program, basically, where there's certain asset requirements that you'll need anywhere from like 12 to 24 months of reserves. And then also, you have to have good credit, typically 660 to 680 or plus. But the higher the score, the less reserve money that you'll need.
And so, because just so I can explain reserves. So if my payment was 2,000 a month, 12 months would be 24,000.
Correct.
That's what you mean by reserves. So that when they say reserves, are taking your payment times 12 to 18 or even 24 months to calculate what you would need in savings.
Right. Yeah. Okay. So if they're buying a house and they need $50,000 to close, they're going to want to have them show the $50,000 for the down payment plus the closing costs, plus they'll need the 24,000 for reserves. Okay.
Now I'm probably going to get. I hope I don't get bad comments because of this one, but I have to bring it up because I have a personal opinion about it. But it's also something. So I'll say my personal opinion, and then you can tell me about this. But I don't want people calling me saying, "Hey, I want to buy an Airbnb." Here's why. When I first moved here, right, and you had condo communities, and the condo communities all are set up with rules and regulations as to how you can rent those buildings. They'll say you could do it once every month, or you can only do it once a year. It doesn't matter if it's for 3 months. They all had rules, because the last thing people want that live here permanently is for who knows who next to you every other day because they're on vacation. And people that we call the snowbirds, that's what they thought. Well, I'll buy a condo and then I'll just rent it when I'm not there. And that's really what the condo communities tried to prevent. And there was no Airbnb. And then also on my investment side, we would have, multifamily, but you had multifamily like duplexes, fourplexes, triplexes, and then with commercial, which I'm not going to discuss in this video, which were monthly annual rentals, anything 6 months in a day or longer. If you didn't have that, then you would have to get charged a tourist tax, and you needed your hotel motel license. Hotel motels is where people would do the vacation rentals. When Airbnb came along, it flipped everything on its head. It did all this crazy stuff. If I see one more video about how to get rich doing an Airbnb, I'm just going to throw up. I can't take it. And people call me and they're going into communities like single family home communities without HOAs. So on a realtor end of it, I am going to say that because I don't want anyone calling me telling me they want that, because I'm not selling it to you. I'm sorry. So I don't think you're a protected class. If you are, then, maybe I will, but I don't think Airbnb owners. So I really have strong opinions about that. Go buy a hotel, go buy a motel, and go do whatever you want there, but stop going into people's communities where we live, where we have children, and then renting it out and doing all these things. And yeah, you could do whatever you want, and everyone watches YouTube videos. But that being said, there is a need for rentals.
Right.
There is a need for smaller investors. We can't have everything owned by BlackRock, right? We just can't. Well, I don't want that either. I just don't, I'm being honest. I don't want these huge companies owning everything. I'm here for the little guy, and that's and the little guy, it's not so little, but compared to these huge companies that are taking over, it's just crazy. So there's people who will say, look, maybe I'm making up scenarios. Maybe you're handy and you see a fourplex and you say, I know I can take that, fix it up, get some more money out of it. I'm going to rent it to long-term people. I'm going to maybe live in one of them, or, that's one program. And then the other one is I'm an investor and I want to take these properties, and I don't necessarily have the income, but because, it's an investor, they're passive income. So can you explain the difference? Because this is the hugest thing. Forget Airbnb, because I'm not doing that, but there's like a debt service coverage ratio, meaning you're an investor, you're not living in it. You're going to buy something and rent it out. We're specifically 4 units and under. That's residential, even though it's a multifamily. Or, hey, I want to live in one and I want to rent out the other 3. Can you explain those two?
Yeah. So the biggest thing that determines it is, are you truly going to live in the property? So if you're going to buy, say, a duplex, and you're going to live in one of the units and rent out the other, that's a typical loan that we can do through Fannie Mae as a primary, and we're able even to use a certain percent of the income that's going to be on that second unit. But that's you buying it as a primary residence where you're going to live in the house. I always tell a lot of first-time home buyers, and I said if I could do it again, my first house would be a duplex, to be able to purchase a house and have someone else pay your mortgage and build some equity, and then eventually parlay that into a bigger house where you'd end up eventually moving out, and now you already have an investment. So that's one thing. So the key is, are you going to live in the property? If you are, that's one option. The other option you're talking about is the DSCR. That's a debt service coverage ratio. That's for your true investor. That's the person that are buying a property to make it an investment property, either fix it up and rent it out long term. And where that's different is basically you are qualified only off the rent roll.
You're qualified. So let me give you an example. To make easy math, they would have to call you. You're going to determine what the right product is, and then you're going to say they're qualified, and then I know what to do. And we're speaking specifically to residential, which means 4 units and under. So you could actually get an FHA loan on a fourplex, put 3% down if you're living in one of the units. But if we are doing this DSCR loan, then I have a fourplex, and each unit, easy math, they're each getting $2,000. That's $8,000 a month. That means my total payment, principal, interest, taxes, and insurance, can't be greater than $8,000, and you can finance it. We can finance it without income. It's going based. This is like typically was a commercial product, so that's the service coverage ratio loans were for 5 units and over, so they could finance this. You're qualifying the property more than the borrower, but not at 3% down. They need 20 or 30% down. Right?
15% is the least amount, but I was 20 to 25. But there's, depending on the score, the least that you can put down on those programs are 15%. But you don't qualify. There's no pay stubs, W-2s. Basically, we're going to qualify that off the appraisal when they do the projections on the rental income in that area. That's what they're going to qualify. And as long as the rent covers the mortgage payment. As far as the average of the rent, that would be something you'd qualify for. Again, that type of property, you need good scores and also a decent amount of assets.
So you need good scores and you could need a good asset, but I've got a guy who's handy. He knows when something needs some work and he can increase rents. He knows that that building has lower rents in the area. And what he's saying is, because it's not going off the lease, because anyone could give you a lease and say, this is the rent is $6,000 a month. We're not going by that. We're going by an appraisal. This is South Florida. We're going by an appraisal. And the appraiser is saying, these are the average rents in the area. They are typically 2,000. Okay. So now this is where this is a true investor loan, and this is a great product. And not only are you improving the community and you're creating long-term tenants and you're having somebody being able to put sweat equity and, really creating value and creating a business. These are call me all day. I love these people. Don't call me if you watch the YouTube video and you think you're an investor and you're doing Airbnb. That's not I'm sure there are people making millions doing that. I don't. So even if you have that product, you can say you have it. They just don't. I won't be helping.
So. I mean, that loan's for people, regular investors that know what they're doing. But, and we do have a few products. It doesn't necessarily have to be one for one. So 8,000, the mortgage payment, and 8,000 for rent. I do have some products that will go less. So say if the projection is only 7,000, but the mortgage payment's 8,000, we will require more assets. But that's still an option out there. So it doesn't have to be a true one for one. So the best advice I always tell people to call me, let's discuss your scenario and see what the best option for you is. But yes, there's a lot of people think that, because a lot of people, can't, if they had to qualify off their taxes and their W-2s, if they own 3 or 4 houses, sometimes that makes it difficult to truly qualify. So that's where the DSCR comes in, where we're qualifying off the rent roll. And again, we want to make sure any loan we ever do, or myself, there's the ability to repay, right? We want to make sure the client can repay. I'm never going to put a person into something that they can't afford. That's just not doing anyone justice.
No, I 100% agree. And that's why I always tell people, here are some options, and please give these people a call. I trust them. I appreciate you taking the time to explain these products. And because I feel like a lot of people think they won't qualify, or that they can't get something.
Or someone told them they can, or whatever. And that's why I always say, pick up the phone, call me, call yourself, basically get in, talk to someone that knows the market and knows the products out there. A lot of people will go into banks, where banks basically have 2 or 3 products. And it's like a cookie cutter. If you don't fit in those 2 or 3 blocks, you don't get a loan. There's all kinds of different types of loans out there for every situation.
And that's what we're here for. Like I said, I'm not knocking, I'm being sarcastic with the Airbnb, but that's really not what I do. But if somebody has that, I do have people, and I say, call these people if this is what you want to do. Just not what I do. So I think that's really, again, the key takeaway too, for anyone listening is, you might call me or Travis. Obviously, we want to do our best to help you with whatever it is. So if we can do it, great. If we can't, between the two of us, we know someone who's really good at getting done what you need done.
Sure, absolutely.
If there's anything you want to add, again, it's Travis Kimball, Supreme Lending, contact information below. If you want to say your email or phone number, or however you want people to call you.
They can call me directly. I always like to talk to people directly. You can text or email, but I'm a communicator. I mean, that's the key to my business is, I'd rather talk to you, learn the whole story, see exactly what we have. Not that I don't respond to texts and emails, but it's just, we're talking old school, but then, or I have a lot of people that come into the office. And I'll take my time, even if you have a general question, pick up the phone. Maybe it's just a general mortgage question. You're not looking for a mortgage right now. Maybe down the road, call me and I can tell you exactly what you need to do and answer your question for you. So,
is there a number or email, or how would you want
Yeah,
them to?
the best number is 561-373-6938. That's my direct line.
All right. Well, thank you so much, Travis.
Well, I appreciate being on. If I could be any help, let me know.
All righty. Well, take care. Talk
All
to you
right,
soon.
thanks. I'll talk soon. Bye.
Bye.